Okay, let's unpack this. Welcome to a deep dive from TalkTickers.
Hey there.
Today we're diving straight into the Cool Company Limited Q1 2025 earnings call.
Right.
And, right up front, the company really framed these results against, well, challenging market conditions. That's kind of the lens we need here.
Absolutely. Yeah, understanding that market softness is crucial. They acknowledged rates on their open vessels face pressure, definitely. But they seem pretty confident they're navigating this period and, moving towards a market they believe is rebalancing.
Okay, so let's hit the headlines first, a quick snapshot of the Q1 2025 results.
Yeah.
What were the key figures?
Okay, starting with the time charter equivalent rate, TCE, the average for the fleet came in at $70,600 per day.
$70,600.
Which is, a bit lower than the $73,900 they saw back in Q4 2024.
A dip there. But I saw total operating revenue actually managed to tick up slightly.
That's right, yeah. Total operating revenue reached $85.5 million, so a small increase from $84.6 million in the prior quarter.
Interesting. And how do they translate lower down, adjusted EBITDA?
Adjusted EBITDA saw a decrease. It came in at $53.4 million compared to $55.3 million in Q4.
Okay.
And operating income also decreased, down from $38.5 million to $34.6 million.
And the net income figure looks like it had a much more significant drop quarter over quarter.
Oh, it did, yeah. Net income was $9.1 million for the quarter. That's a notable step down from $29.4 million in Q4. Quite a difference.
Wow. Okay. Beyond the raw numbers, though, they did highlight some operational wins in the quarter.
Yes, definitely. Some key operational points. The successful delivery of their new build, the Gale Saga, right on schedule. That's big.
Always good to see.
Yeah. And they also secured employment for 2 vessels that became available during the quarter, which is, pretty important in a soft market.
Right.
Plus, they completed 2 dry docks in Q1, and then a third one finished just after the quarter ended. So ticking those boxes.
Okay, so when we look at those numbers, slightly lower TCE and profitability metrics, but increased revenue and solid operational progress. How does that picture fit into that challenging market they described?
Well, I think it tells a story of, active management during a bit of a tough patch. The revenue increase, despite the lower average rate, it suggests they kept their vessels earning for more days overall. Even if specific factors brought the average TCE down a bit, which, we should definitely dig into.
Yeah, let's see there.
And those operational achievements, like bringing the new ship online and finishing the dry docks, it shows they're executing their long-term plan. That's crucial when the day-to-day spot market is weak.
Okay, let's get into that deeper dive then. Starting with the financials and operations, you mentioned specific reasons for that slight dip in average TCE. What were they?
Yeah, so the company pointed primarily to increased repositioning expenses.
Okay.
A big chunk of that was $1.9 million specifically for moving the new Gale Saga, getting it from Korea over to the US Gulf for its long-term contract start.
The delivery voyage cost, basically.
Exactly. And they stressed this was a one-off for the new build, not something expected next quarter.
Right.
There were also some repositioning costs for other vessels redelivered into the spot market. And of course, the planned off-hire time for the dry docks impact the total earning days and therefore the average rate calculation.
Got it. So one-time costs, repositioning, planned downtime, offsetting the earning days. But how did revenue increase then if the average rate was lower?
Good question. That was driven mainly by the new Gale Saga contributing revenue for a full quarter after its delivery back in early January.
Okay. Full quarter effect.
Right. Plus, their vessel Cool Tiger, which operates in the spot market, it actually had more on-hire days on spot charters compared to the previous quarter.
Okay. Yep.
So these factors together more than compensated for the fewer earning days from those scheduled dry docks on other ships.
Okay, that makes sense. More ships operating for more days, pushing up total revenue, even if the average rate per day dipped a bit due to those specific costs or vessel mix. Now, the adjusted EBITDA decreased.
Yeah.
You said that was linked to the new build costs.
Right. The decrease down to $53.4 million was largely influenced by higher vessel operating and voyage expenses directly associated with the delivery and, that initial positioning of the Gale Saga. And it's worth remembering, adjusted EBITDA strips out non-cash items like amortization, which was about $3.7 million in Q1.
Okay. And the net income drop, that was much bigger. nearly $30 million down to just over $9 million. What drove that larger swing?
That was a few things really stacking up. First, you had the lower operating income we already talked about, contributing to the decline.
Right.
Then they incurred $2.8 million in interest expenses for the Gale Saga financing, which obviously started after the delivery.
Makes sense.
But the most significant factor, the real kicker, was a $14.3 million quarter-over-quarter swing in the fair value of their mark-to-market swaps.
Ah, the derivatives.
Exactly. They had a $9 million unrealized gain on these swaps in Q4, but that flipped completely into a $5.3 million unrealized loss in Q1.
Wow.
Primarily driven just by changes in market interest rates. So that non-cash valuation change really hit the reported net income figure hard.
Yeah, that non-cash item
Yeah.
certainly explains a huge chunk of the difference between operating income and net income.
Mm-hmm.
Okay, switching gears a bit.
Yeah.
One of the big anchors for stability for a company like this is always the contracted revenue backlog. What does that look like for CLCO?
Oh, it's massive. Their total contracted revenue backlog exceeds $1.6 billion. And that includes all the potential extension options on their charter.
$1.6 billion.
Wow. Yeah. To put that in perspective, it represents roughly 59 vessel years of backlog, or, about 4.5 years of secured work on average per vessel across their entire fleet.
That's a significant amount of visibility, a really strong buffer against the current soft spot market.
Absolutely.
And what kind of average rate is that backlog locked in at?
Well, on the firm and floating portions of that backlog, which totals about $1 billion of the $1.6 billion, the average TCE rate is around $78,000 per day.
$78,000. Okay, so notably higher than the $70,600 average they actually achieved this past quarter.
Exactly. That really highlights the benefit of their existing long-term contracts, doesn't it?
It certainly does. And how much of their operating days does that huge backlog cover in the near to medium term?
Yeah, they give specific coverage percentages. For the rest of 2025, they have approximately 83% of their vessel days covered by existing contracts.
83% for the rest of this year. That's strong.
Very strong. Looking further out, they are roughly 72% covered through the end of 2026.
Right.
And about 63% cumulatively covered through the end of 2027. So that provides a substantial base of secured revenue, protecting them from needing to place too many vessels in this weaker spot environment right now.
Yeah, that makes a big difference. Now, another operational point they highlighted, you mentioned earlier, was the trend in their vessel operating expenses, their OPEX.
Oh, right, yes. That's interesting they mentioned it trended downwards.
Yeah, what was the figure and what's driving that improvement? Because usually costs go up, right?
Well, it did trend downwards. The average vessel operating expense per day, per vessel, in Q1 was $16,300.
$16,300.
Which is lower than Q4, lower than the full year 2024 average, and actually a pretty significant drop from about $17,600 per day a year ago in Q1 2024.
Okay, so what's the secret sauce there?
They credited it mainly to completing those dry docks on time and within budget. They've done 7 since Q2 2024, including the 2 in Q1 and the one right after,
Right.
and generally driving operational efficiencies across the fleet. These dry docks often include performance upgrades too, which can help reduce fuel costs over time.
Efficiency gains kicking in.
Exactly. They have 3 more dry docks scheduled over the next 12 months, and they expect these cost benefits to continue. So good focus there.
Okay, let's shift gears now from the company's specifics to the broader market landscape they described. What's really driving the softer rates we've been seeing in the LNG carrier market lately?
Well, the core dynamic they discussed really revolves around cargo destinations, specifically Europe.
Europe again.
Yeah. Europe had a colder winter than the previous year, which drew down storage levels quite a bit, down to 34% in April. Compare that to 60% last year at the same time.
Big difference.
Huge. So this created a real necessity for accelerated restocking. On top of that, you had relatively healthy LNG prices. TTF around $11 plus per MMBTU compared to maybe $8 last year. Still competitive enough to pull volumes into Europe, especially with, reduced Russian pipeline flows.
So Europe is pulling in cargoes, but that's kind of hindering demand elsewhere. Is that the idea?
Exactly. These elevated prices, while okay for Europe, are simply too high for many traditional price-sensitive buyers, particularly in Asia.
Right. The Asian buyers need lower prices.
Precisely. So this suppresses what's typically a strong pull from the East. The market is really waiting for that pivot back towards longer haul voyages to Asia.
Okay.
European storage levels are now rebounding. They mentioned near 45% in May. And the expectation is that as Europe gets more comfortable, prices should soften a bit, making LNG more attractive to Asian buyers again.
And that shift would increase shipping distances, ton-mile demand.
Exactly. Ton miles are currently not that strong, but they usually pick up from Q2 onwards. So that shift is key.
And the data they presented on US LNG destinations, that really underscored the European focus, didn't it?
It really did. In March and April, they said 80%, 80% of destination-flexible U.S. LNG went towards Europe.
80%. Wow.
Yeah, compare that to less than 50% during the summer of last year. It just shows how heavily the market has been skewed towards the Atlantic basin recently.
That's a massive concentration. And they raised an interesting point, too, about potential LNG imports being used to address trade imbalances. That sounded intriguing.
That was a fascinating little nugget, wasn't it? They suggested countries could strategically increase LNG imports from the U.S. just to help manage their trade balances.
How would that work?
Well, as an example, they noted Chinese buyers actually sold 15 cargoes that were originally meant for China into Europe in Q1.
Okay.
Now, if those same cargoes had gone to China instead, that would have required roughly 12 additional ships annually, just for that volume.
Just for those 15 cargoes?
Yes, for those. So scale that up across different players and volumes. A shift back to Asia for trade balance reasons alone could actually be a significant demand driver for shipping, independent of pure energy needs sometimes.
Huh. Interesting angle. Okay, this brings us to probably the most anticipated theme, the big wave of new LNG supply.
Ah, yes. This is the key bullish argument for the sector that the company really hammered home.
Right.
They made it crystal clear that a massive amount of new LNG production capacity is coming online, and very soon. A sharp contrast to the relatively flat supply growth we saw in 2023 and 2024.
So the wait is almost over.
Pretty much. They see projects nearing completion as real catalysts for shipping demand over the next year or two. Specific projects like PlacMines and Corpus Christi Stage 3 ramping up in the U.S.
Yep.
LNG Canada expected to start in Q3. Qatar's massive North Field expansion begins phased deliveries in 2026. Golden Pass in the U.S. expected late 2025. It's a lot.
And the scale of this growth is pretty substantial overall, right?
Oh, it is. They project total global LNG supply to grow by over 20% from 2024 levels by the end of 2026.
20% in just over 2 years.
Yeah. And on top of that, another 6% growth projected in 2027 and a further 10% in 2028. This is the wave everyone talks about. And all that new volume absolutely needs ships to move it. The pressure on rates right now is partly because ships delivered during the recent ordering boom arrived, a bit before the supply really hit the water.
Gotcha. The ships arrived before the party started, essentially.
Kind of, yeah. But the party's definitely starting now.
Okay, so that's the demand side for shipping, driven by LNG supply. What about the vessel supply side itself? Are we still seeing tons of new orders?
Well, while there was that significant ordering spree from 2022 to 2024, ordering has actually sharply dropped off in 2025.
Ah, okay. Market correction.
Yeah, it's a natural market response and ultimately positive for longer-term rates by limiting future supply growth down the line.
Right.
They also look at indicators like idle vessels and are seeing a growing correlation between vessels reaching 20 years of age and basically entering retirement or scrapping.
So older ships heading out.
Seems like it. They pointed out that of the new builds still scheduled to deliver, only around 29 remain open for employment, meaning not tied to a specific project yet.
Okay, 29 open new builds.
Meanwhile, the potential replacement demand for older vessels could be as high as 60 ships by the end of 2026.
So replacement demand could actually outstrip the open new builds?
Potentially, yes.
Yeah.
It suggests that the market can absorb a significant amount of new tonnage, partly just by displacing older, less efficient ships.
Right, the natural cycle.
Yeah.
Newer, more efficient vessels push out the older ones.
Exactly. And the company feels this displacement is actually happening at an increasing pace right now, partly because modern ships just offer much better fuel efficiency and lower operating costs per unit of cargo. Makes sense.
Okay, so given that whole picture, how is CLCO positioning its own fleet strategy in this environment? What's their approach?
They describe their strategy as, managing risk, trying to capture potential upside on a limited number of vessels, maybe they're spot vessels, while securing enough long-term contract coverage across the rest of the fleet to strategically stagger their exposure to the spot market over time.
Balancing act. And they executed on that strategy in Q1 by fixing 2 vessels that had come open, right?
He did, yeah. They secured employment for 2 of their TFTE vessels. Those are the tri-fuel diesel-electric ones, a slightly older generation tech compared to the modern two-strokes.
Okay.
Doing that reduces their TFTE spot exposure down to just 2 ships in the second half of 2025.
And what kind of deals were they?
One was a 12-month charter starting back in April. The other was a variable rate deal, but with a floor starting in August.
Variable rate with a floor. Interesting.
Yeah, and both deals include upside sharing mechanisms, so they can benefit if the market strengthens or, based on operational performance. They estimated that could add around $5,000 per day, depending on conditions. So locking in coverage, but keeping some potential upside.
Smart. What about the outlook for the modern two-stroke market?
Yeah.
Specifically for their vessel Cool Tiger, which has been operating spot.
Yeah, the two-stroke spot market has actually been quite active. They mentioned a record number of spot fixtures recently.
Oh, really?
Yeah, and Cool Tiger has achieved nearly full employment in this market, apparently at rates above the recent lows. They expect seasonal strengthening from here as well.
Okay.
Now, while charterers are currently, comfortable taking near-term spot risk, which limits long-term business opportunities for two-strokes right now, they are seeing more inquiries for multi-year contracts starting to come in, so the interest is building.
And they noted a recent market signal from another company that looked positive.
Yes, exactly. Capital Gas recently announced 2 term charters for their two-stroke vessels starting out in 2027. Reportedly at reasonable rate levels.
Okay.
CLCO views this as a really positive signal for the longer-term rate environment for modern two-stroke tonnage. It reinforces their confidence that they will eventually secure long-term employment for Cool Tiger at strong rates.
Right. Gives them some comfort while they wait for the right deal. Okay. The analyst Q&A always brings up some good points. What were some key questions raised there?
Yeah, always interesting. One question was about the tipping point for charterers. When do they switch from taking spot risk to locking in term coverage, particularly for longer durations like 3-5 years?
Yeah, good question. What was the answer?
The response was that there is interest in those longer durations, especially for the newer vessels and even for the TFTEs, but the market is in a contango structure right now.
Yeah.
Meaning near-term rates are accepted as soft, but longer-term rates are expected to be significantly higher.
Oh, okay.
And that gap, that expectation of higher rates later, can sometimes make charters prefer shorter deals for now. They're waiting for more clarity on exactly when the market shift will really bite.
Makes sense.
Yeah.
What about the potential impact of all that uncontracted U.S. Gulf volume that's coming online? That must have come up.
Oh, yeah, absolutely. They highlighted this as a critical factor. The volumes from projects like PlacMines and Golden Pass are definitely coming, and they will make a material difference to the shipping market, no doubt.
Right.
But the absolute key, they stressed, is where those volumes end up. Destination is everything.
Europe versus Asia again.
Exactly. If those volumes primarily flow to Europe, far fewer ships are needed than if they flow all the way to Asia. This real pivot factor, the destination mix of this new U.S. supply, is probably the single biggest variable determining the impact on shipping requirements and, future rates.
Got it. What about asset prices? Are vessel values coming down along with the softer spot rates we've seen?
Interestingly, no, not really. The company stated that asset prices remain quite high, effectively anchored, they said, by the high cost of new builds.
Still?
Yeah. They estimated modern two-stroke vessels are still trading around $250 million plus, maybe down only slightly from a peak near $260 million. So people's expectations for resale values seem very much set by those high new build benchmarks.
Okay. And are they actively looking to add more vessels to their fleet, given the potential future market strength they anticipate? Are they buying?
They said they're always looking for opportunities, and they maintain a disciplined approach to acquisitions, referencing their history of making opportunistic deals in the past.
Right.
However, they haven't found a landing zone yet, as they put it, meaning at current price levels, nothing has quite met their criteria.
So patient but watching.
Exactly. Actively evaluating, but patient.
Okay. And finally, there was a question about potential U.S. port fees linked to Chinese vessel leases. Seemed a bit specific.
Yeah, it's a nuanced issue, but for the specific LNG fleet, they basically said Based on current rules, something about Annex 4, their vessels are not expected to be affected until way out in 2029 or 2030.
Oh, okay, not an immediate concern then.
Not really, no.
Yeah.
That's when some targets around U.S.-built vessels come into play. So their vessels, including the 2 new builds that do have Chinese leasing structures, they're not impacted by the current rules in the way some other shipping sectors might be, at least not for several years.
Right.
There is some broader ambiguity, they admitted, around legally Chinese-owned vessels, which they are monitoring closely, but it doesn't apply to their structure currently.
Okay.
Oh, and they also noted their call options on their existing leases have prepayment penalties in the initial years, 3% for the first 3, then 1.5% for the next 3, just a detail on their financing flexibility.
Got it. Okay, so pulling all this together then.
Yeah.
What are the key takeaways you, listening, should be considering from this cool company call?
Right. Well, first, really grasp how they are navigating this currently soft spot market, their primary defense. That huge contracted backlog, over $1.6 billion.
Yeah.
Giving them coverage for over 80% of their days in the second half of 2025. That is a massive buffer against low spot rates. Really important.
Okay, point 1, backlog stability. What's next?
Second, appreciate the impact of their operational focus. Completing those dry docks on time, on budget, driving efficiencies. It's resulting in tangible cost savings.
Right.
Pulling down average vessel OPEX per day.
Right, the $16,300 number.
Exactly. That directly benefits their margins, even in a tough rate environment. So operational execution matters.
Okay, third point.
Third, note the financial strength and flexibility they highlighted.
Yeah.
Healthy cash balance, $136 million. $120 million available under their credit facility, and no debt maturities until mid-2029. That puts them in a really solid position.
Good runway there.
Yeah, and plus they've proactively hedged about 75% of their debt at an average rate of 5.7%. Reduces their interest rate risk quite a bit.
Okay, financial strength.
Yeah.
And their share repurchase program, that's usually a signal too, right?
Absolutely. That's a good fourth point. The fact they are buying back shares, having purchased about 692,000 shares at around $559 per share, which they state is well below their estimated net asset value.
Mm-hmm.
That's a move supported by their liquidity, sure, but it also signals management believes their shares are trading below the fundamental value of their underlying assets right now. A confidence signal.
Okay. And finally, maybe the most important one looking forward.
Yeah. Finally, understand how they are positioning themselves for that future market shift everyone's talking about.
The big rebalancing.
Exactly. This is perhaps the most forward-looking insight from the call. The core thesis they presented is significant wave of new LNG supply starting now, ramping up dramatically, combined with the accelerating rate of retirement for older, less efficient vessels. Their belief, their whole story, is that this supply growth will absorb the current vessel oversupply and lead to improving rates in the medium term. And their modern fleet and strategic backlog are designed to benefit when that happens.
Okay. But the pivotal uncertainty, the thing to really watch,
is where that huge volume of new US LNG production ultimately goes. Destination, destination, destination.
Europe versus Asia.
Right. Does it keep flowing mainly to Europe, or do lower prices eventually enable that long-awaited pivot back to Asia?
Right.
That destination split is probably the single biggest factor that will determine the trajectory of ton-mile demand and just how quickly the shipping market tightens up again. That's the key variable.
Okay, crystal clear. Right, let's switch gears entirely now. This is purely a thought experiment, okay? Absolutely not financial advice in any way, shape, or form.
Definitely not. Just kicking ideas around based on the call.
But based on the fundamental dynamics discussed in the call, you could maybe construct a potentially outrageous but plausible trade idea.
Okay, I'm listening. Given the strong emphasis the company placed on that impending wave of new LNG supply needing modern vessels, and their discussion of the accelerating displacement and retirement of older, less efficient tonnage, the outrageous but plausible pitch could be something like this. Take a long position in Cool Company Limited shares.
Okay.
And perhaps, hypothetically, pair that with a short position in shares of companies that primarily operate older, less efficient steam turbine LNG carriers. If you could even find a pure play like that easily.
The old versus new trade.
Exactly. The logic, coming straight from the narrative presented in the earnings call, is that CLCO's modern fleet, their substantial backlog providing stability, and their strong balance sheet position them well to benefit from the fundamental market rebalancing, the one driven by that massive supply growth and accelerated scrapping trend. While the hypothetical short side is based directly on the call's thesis that older tonnage, the steam turbines, are increasingly becoming obsolete, They'll face declining prospects as they get displaced by newer ships and potentially face higher operational costs or maybe even regulatory hurdles over time.
Now, the outrageous part, of course, is the practical difficulty. I mean, identifying and easily shorting specific small-cap shipping companies focused exclusively on older vessel types, that market can be incredibly illiquid or maybe even non-existent for practical purposes.
Yeah, finding that pure short is the tricky, maybe impossible part.
Right. But as a theoretical representation of the market forces discussed in the call, the fundamental logic is at least plausible.
Yeah.
Based on what they laid out.
Plausible logic, difficult execution. Got it.
Again, purely hypothetical, absolutely not financial advice. Just connected the dots from the call.
Okay, so to bring it all back together then, the core story from the Cool Company Q1 2025 call is really a company actively managing through a current challenging spot market, leveraging a stable contracted backlog, successfully driving those operational efficiencies we talked about, and maintaining a pretty strong financial position, doing the right things now.
And crucially, they are positioning their modern fleet to try and capitalize on a significant potential market rebalancing that they and many others expect over the next few years, driven by that massive influx of new LNG supply and the concurrent potentially accelerating retirement of older vessels.
Right. And just one last reminder for everyone listening. The information shared here is purely for informational purposes. It should definitely not be considered financial advice. Please do your own research.
Absolutely. So the thought we'll leave you with from this deep dive is this. How quickly will that forecast wave of new LNG supply, combined with the scrapping of older ships, truly absorb the current tonnage oversupply? And how fast could it potentially shift market power back towards vessel owners? What does the timing of that shift really imply for the whole LNG shipping sector over the next 2 to 3 years? Something to mull over.